Good morning, everybody. Uneducated Economist here. So the ECB, the European Central Bank, has started capping bonds, and they don't call it yield curve control, but essentially it's yield curve control. And this is their attempt to keep interest rates from rising. And I had imagined that the Federal Reserve would probably do something very similar to this if, like, the 10-year continues to, if the yields on the 10-year continue to go up. I don't know if they would reach all the way out to the 10-year, but they might grab us, say, all the way out to the 3-year. And what they'll do is they will buy a particular maturity of bond, and at any rate, like or not at any rate, but at any amount that is needed in order to prevent the yield from going to a certain level. So that's kind of difficult to understand if you're not quite familiar with like bonds, bond yields, yield curves, and like how they control this yield curve. But essentially, what the Federal Reserve does is they buy bonds from the big banks out there. And when they buy these bonds, what it does is it adjusts the price of the bonds that are out there on the market. Just like any other commodity or anything else out there, these bonds have a price tag attached to them. Not only do they have a yield, like what the investor will get from the interest of the bond, but they also have a price tag, and that's where that yield changes. So what the coupon rate of the bond is. Now, that's the interest rate that the bond pays. That is set. That doesn't change. What the investor will receive after the purchase of the bond is the yield. So the bond price may go up, and if that bond price goes up, what the investor will get from the interest rate that the bond pays will drop. So as prices go up, yield falls. And as the yields fall, that's the interest rate around everything. So if the 10 years starts to increase in interest rates, you're going to find mortgage rates increasing, car rates increasing, credit cards, everything out there that has a loan attached to it will start to tick up because the 10 year is like the benchmark for all loans. Wherever the 10 year goes, so go all loans. So what the Federal Reserve or what the central banks out there, not necessarily the Federal Reserve, right now it's the ECB who's doing it or saying they're going to do it. What the yield curve control will do is they will reach out there on a particular maturity and say that they will buy as much as needed in order to keep the interest rates from rising on that. The investors will hear that and think, okay, we need to front run the Federal Reserve and make sure that we buy up before they have a chance to, because if the interest rates reaches this particular level, the Federal Reserve is going to be there to buy it. They're like basically guaranteeing a buyer of bonds, is what they do when they say that they are going to cap them. They say that if they're going to reach this level, we are going to buy at any rate or at any level to bring that rate down. So as I'm reading some articles on this, I found two articles that I want to post. One of them has the word jawboning right in the title, and the other one has, and I'm not sure if they were trying to quote one of the central bankers, but it's written in the article that in order for the capping of bonds or yield curve control to work, that the pledge has to be credible threats. See, they have no intentions on actually buying bonds. They just want to tell people out there that they want to buy bonds. They will buy bonds. And if the yields start to increase above them, they will go out there and buy those bonds in order to bring those yields back down to the level that they are requiring for the to control. Because control is an illusion. But that's what the idea is that if they put that thought out there, if they put that wording out there, if they put that credible threat out there, then the investors will essentially do the job for them. See, I went back and I was reading some of the statements that were made by some of the central bankers during the yield curve control that took place after World War II, and that's exactly what they said, is that although they, would buy at any rate in order to keep the yields low and the prices elevated on those bonds, ultimately during that yield curve control, they really didn't have to do a whole lot as the investors were doing the work for them. Now, the idea of doing this yield curve control is to keep those interest rates low. And this should kick in more of that inflation thought, okay? Because inflation is an expectation. It's not an actual thing because there's plenty of inflation to go around. Inflation is the expansion of money and credit. We have had plenty of that around. So the inflation is already here. What we don't have is the Federal Reserve showing all the signals that inflation is here. And there's plenty of argument to go around, especially if you go to places like Shadow Stats, to find the true like inflation numbers to the way that they had them, the metrics that they had years ago. You can find today that inflation is running rampant. What we don't have is money velocity happening. That's where all the stimulus checks and everything else that are coming in is they're desperately trying to spark that money velocity to go. But once economies have reached a debt to GDP level of, I forget what it is. They had like a certain number, 90%, 91% of GDP or something like that, and we're well over 100% of GDP. Once it reaches a particular level, and I thought it was like 90%, the economy drastically slows, and that it's very difficult to get it moving again. And we just keep going deeper and deeper and deeper, and it's getting ever more increasingly difficult to try and get the money velocity going. Pretty soon, like $1,400 checks, it's going to be $2,000 checks a month. I mean, it'll eventually get to a point where it's going to be like a ridiculous amount of stimulus every single month, all the time. And how that could possibly like be a viable future to that is just beyond me. So at some point, I just feel that free market forces are going to correct things. And when they do, man, it's going to be damaging because there is so much debt out there. It is like insane amount of it. And a lot of people are looking at all this money printing thinking like, if they go into yield curve control or something like that, it's going to be even more insane amount of money printing going into it, which it could. I mean, if people start losing faith and they just like, they don't trust loaning their money out there to anybody, especially the investors, and the Federal Reserve is forced to step up there and actually do it, yeah, it could create a lot of inflation really fast. But that money velocity is very difficult to get going, and they're desperately trying right now. Some of the things that I kind of foresee going into the future here is that it's pretty obvious that things are going towards like digital currencies. And that shift that takes place, that that time when people are like go back and like, man, remember when everybody used to use cash and they don't use cash anymore? And remember when we used to use credit cards but all we use is our phones? And then pretty soon it's just like it'll get to a point where like the entire system will be tokenized. And it's hard to envision. It's hard to like kind of lead into this, kind of thought. But that's what things are going to. I mean, just, check out central bank digital currencies, and you will find that pretty much every central bank around the world right now is desperately trying to figure out how to get into a central bank digital currency, how to get theirs implemented and moving. I mean, it's a sign of times to come. And, a lot of people ask me, I was just like, well, where do you go? Where do you put your money? It's just like, I really don't know. I mean, I've told people time and time again, the 3 places that I put my money is cash, silver, and Bitcoin. Is that the correct place to go? I have no idea. But that's where I'm going because there's no place to save. And those are the safe havens that I see that's somewhere outside of the system. And a lot of people are laughing at that because they think cash is outside of the system. But when you look at cash, when you look at Federal Reserve notes as the first lien paramount right to the Federal Reserve balance sheet, if they go bankrupt and SDRs and gold gold then SDRs are the number one things on their balance sheet listed, not the most and as far as dollars, but they're the number one assets that are listed on their balance sheet. Yeah, I think cash has a little bit more value than people are thinking it does. And there's really not that much cash out there. There's plenty of digital numbers on the computer, plenty of digital numbers in bank accounts, but there's not as much cash as people think. The folding notes, the first lien paramount right to the Federal Reserve. Gold has been money for 5,000 years. There's no reason to believe that it won't be for another 5,000 years. There is absolutely none. People can say there has been movies made from years ago where people were throwing gold in the dirt. It doesn't matter. Gold is still valuable today. People have many times said that gold is going to go to zero and that people will think will have no value with it anymore and it'll be worthless. It'll be like a trinket. No, I do not think so. It will never happen that way, ever. It is ingrained in humans. I don't get it. I don't know why, but I do know why, but I'm not going to get into it today. All I'm saying is that if gold has been money for 5,000 years, I assure you it will be money for the next 5,000 years. And as far as Bitcoin, yeah, it could be a scam. I don't think so. I mean, it's been 10 years now. People have said that it was going to fail, that it was going to be worthless, that it's a scam, that it's a Ponzi scheme, that it's, all this stuff. Okay. I've heard it time and time again. People told me it was that at $18. They told me that at $850. They told me at $18,000. They're telling me now at $40,000. Okay. I mean, that's fine. You can go ahead and believe that all you want. I'm not, I'm not a believer in that it's a scam or a Ponzi scheme or any of that stuff. I just don't. Yeah. I'm not putting all my money into Bitcoin. That would be ridiculous. You know how volatile that stuff is? You put your money into Bitcoin today, you're going to probably have half of it tomorrow. But I put $50 every now and again towards Bitcoin, and I tell you, it's gone pretty well over the last few months. Yeah. You guys seen the videos that I've done of silver. I purchase silver regularly. It's a savings account for me. It's my insurance policy. And now I'm holding cash. And these things are the only places that you can really go that is going to get you outside of that third person party, or that third party, not the third person, but the third party. Once you have separated yourself from those things, then stepping back into investments where you are handing your money over and saying, okay, I'm hoping to get a return on this, gives you a little bit better ground to stand on. You see, people want that ultimately. In the end, those are the things that they're going to want, are those three items. As everything begins to crumble, as debts need to be repaid and nobody has the money to do it, they are going to be dying to get their hands on anything that has any kind of value to it. And paper promises will not be it. Sorry for rambling off there a little bit in the end, but it's kind of the things that I see coming in the future. And with you got the ECB capping bonds right now, I can only assume that it's only a matter of time before the Federal Reserve does it as well. Especially if the interest rates, like at the yields on the 10-year, start to rise, causing the interest rates to go up, you're definitely going to see the Federal Reserve stepping in with some yield curve control. How much money printing they need to do in order to effectively control the yields on particular maturities is still questionable. I mean, I wonder how much they are actually going to have to buy to establish that credible threat. I mean, it's pretty obvious to me that the investors love what the Federal Reserve says and just follows whatever they say. I mean, think about the corporate bond purchases. I mean, everybody was convinced. I could not believe how much I heard about how the Federal Reserve was diving head first into the bond market, and they hardly did any corporate bond purchases at all. They just did a little bit, but everybody was convinced that they were going to do it. That's all it took. It's all about job owning. It's all about the credible threats. It's all about that belief that people have that the Federal Reserve will do what they say they will do, and they will do it just to prove that they will. It's a strange thing to think of, but that's exactly how the whole system is now working. And if they can convince you that inflation is going to come and you start behaving in a way that you believe inflation will come, then inflation will come. And once it starts to come, then they can start doing something about it. You think about it. Once you step in, this is also written in the article, but once you step in to yield curve control, right, and you make that promise, we will not let interest rates go up above a certain particular maturity or level on a particular maturity of bond, it's almost impossible to exit from that, because the moment that you say that I'm not going to buy this stuff anymore, the investors are like, well, yeah, neither are we, right? And then all of a sudden the interest rates will start to rise as they try to seek out an investor to buy some of the bonds. So it's going to be very difficult for the Federal Reserve to say, okay, well, we're done in the yield curve control thing, because the investors will be like, yeah, we're done too. If you're done, we're done. Yeah. And that's going to cause, a problem with the interest rates rising. Of course, if inflation is running rampant right then maybe they want the inflation to run or want the interest rates to run high in order to deal with the inflation if it's running hot. So maybe yield curve control is actually a way of governing rising interest rates that they expect to come into the future. Like if they didn't have yield curve control to get rid of, then they wouldn't have the availability of, like, instead of just like raising interest rates, like they don't want to raise interest rates. We're like, we don't want to take our Fed funds rates up. But if we quit yield curve control, that would cause interest rates to rise and we wouldn't have to mess with our Fed funds rate. You see where I'm getting at? It's kind of like getting ammo. All right. I babbled on long enough. Uneducated economist, you guys let me know.